the Fed's going to probably see inflation at around 2.4, 2.5%. I think there's a reasonably good chance you get the first Fed rate cut March 20th at that Fed meeting. And certainly by the May Fed meeting, based upon what we see with inflation down here, you'll definitely have to see the Fed cut. And then it gets under 2%, which means the economy is really faltering. So we think that the odds are very strong for a March 20th rate cut, but almost a lock for a May 1st rate cut. Now, there's odds makers that do that, just like there was odds on last night's game or yesterday's game between the Bills and the Steelers, or between the Eagles and the Bucks. There are odds makers on whether the Fed will cut or not. And they agree with us. January 31st, there's only a 3% chance of a Fed rate cut. So these are the odds, but what we showed you is the logic behind it. March 20th, remember we said there's a pretty good chance. The market currently says 67% chance of a Fed rate cut March 20th, and essentially saying a lock by May 1st. And here you can see the odds of multiple rate cuts within this period of time. So we're going to start to get lower rates from the Fed. And in fact, let's go by the last Fed meeting and see what the Fed members told us. So there's something called the dot plots. This goes by year. This is 2023, 2024, 2025, 2026. Each dot represents, in an anonymous way, what each Fed member thinks we're going to be on interest rates for the year. So there are two Fed members that think that the interest rate stays where it is between 5.25 and 5.5, so 0 cuts. One thinks a 25 basis point rate cut in 2024. There's 5 members that said at least 2. There's 7 members that said 6. There's 4 members that said, say 3, pardon me. 4 members that say 4 cuts. 1 member that says we're going to cut 6 times or 150 basis points. So you can see where the Fed's mindset is, and that's why people are saying it looks like the Fed's telegraphing around 3 Fed rate cuts this year. But they also are asked, where do you think the unemployment rate is? And I think this one gives us some more insights. I want you to also look at the trajectory. When you look at 2024, notice something about 2025, even lower rates, and 2026, even lower rates still. So this is telling us that the future looks good, folks. What we see this year, well, this year we think is much better. As I explained to you, the supply situation should be better. Look, there's always going to be things that could surprise you, but we think the outlook is much better. We think mortgage rates start here in the high 6s, but they move towards the mid 5s. And a rate under 6% should unlock a lot of move-up buyers for you. The 10-year Treasury, the very high end of it should be maybe 4.4, but we see it gravitating towards 3%. And look, it would be really nice if also mortgage spreads were closer to the normal for their 10-year treasuries, which historically mortgage rates are about 2% above the 10-year Treasury, even a little less. Now they've been like 3% above the 10-year Treasury. So it's been improving, right? It's been improving. So maybe it's like 2 3/4 now, but still it's abnormally high. But as those spreads contract, if they move towards a more normal 2%, well then, low 3s on the 10-year Treasury means low 5s on mortgage rates. So we think that this is going to be a much better year for mortgage rates. Now, folks, real estate, big one on real estate, where people are talking negatively. They say, no, the housing bubble. Look, in the housing bubble in 2007, there was 4 million units in inventory. Today, 1.1 million. But look what's happened to our population. In 2007, it was 301 million. Today, it's 340. We have 39 million more people in the U.S. fighting for 3 million fewer homes. No wonder why inventory is tight. No wonder why prices are going up. And how in the world could you have a bubble? Now, it's worse than that because you've got 1.1 million homes on the market, but it's so hot, 416,000 are already under contract off the market. There's only 714,000 active listings. That's less than half of the norm. People want to bet against housing. You're betting against the champ. Look at the last 81 years in the housing market. 81 years. People are forgetful that 75 out of 81 years, values went up. They only went down 6 out of 81 years. In 1 year, it was less than 1%. So if you look here, you could see the market's been appreciating quite a bit, 10%, 19%, 6%. So these are big numbers. And people say, wait a minute, we've gone up on a compounded basis, 40% in 3 years. It's got to crash, right? Well, let's look at history. Has it ever happened before? Heck yeah. Here, we went up 118% in 6 years. If you thought it was going to crash and you were waiting to buy because of a crash, well, you had to wait a long time, 59 years before prices drop. And along the way, you missed 12% in 1 year. You missed 93% in 6 years. You missed 10%, 8%, 7%. You missed this big run up here. Everybody's just worried about this. But there were factors there. One, I explained to you, inventory and population. Two, it was household formations. Look at the blue line. Much less households being formed and builders putting up homes like crazy. 2 million homes a year. Today, we haven't put up 1.5 million. But look at our household formations. We're forming 2 million households a year. And also the underwriting guidelines. I mean, what was the underwriting guidelines back here? No income, no asset, no job, no down payment, bad credit. You're approved. Obviously, we don't do that today. Now, what's our forecast for housing? Let's take a look at 2023. I'm very proud of this because in January 2023, what did we say? We said 6.8%. It was very unpopular because people were talking about there's going to be a housing bubble crash. People thought prices would drop 25% because rates were going to go higher. What happened? We said 6.8%. And where are we? Now, the latest data we have is through November. December's data hasn't come out yet. But through November, it's 6.4. We think it'll be almost an exact bullseye of our forecast at 6.8%. Pretty darn good. Where do we look as far as this goes? Well, we were like the only ones out there. And if you read John Malden's thoughts from the front line, is the top economist in the world. Housing is a lot stronger than anybody would have thought it would be. Well, other than Barry Habib, it was very kind of him. So what do we see? We see 4.5% to 5%. If you pencil in 5% appreciation in 2024, we think you're pretty safe. Transaction volume, big thing for you and your realtors, up 15 to 20%. Yes, it's from low levels, but you will do more purchase volume this year. Now, let's show people how that creates a lot of wealth. Imagine a $500,000 purchase price. If you put 10% down, that's a $50,000 investment. Now, your payment is going to be on a $450,000 mortgage, but as I explained to you, somewhat similar to rent, especially when you take into consideration what the amortization portion is. So your cost out of pocket similar to finance it, the other $450,000, or if you threw the money away in renting. Now, take a 5% rate of appreciation. On $500,000, that gives you a $25,000 profit. A $25,000 profit on a $50,000 investment is a 50% rate of return. 50. This is how you create wealth in real estate. One last point here. As people talk about affordability. Affordability is not as bad as you think. Let me show you. It is worse, of course, and affordability has gotten tough. But I want to show you something. In 2021, imagine a $1,000 a month principal and interest only payment. Principal and interest, $1,000 a month, is based on a 240 mortgage at 2.875 rate. In order to qualify for that, on average, you'd have about a $4,000 income for a $1,000 a month just P&I payment. Well, where are we today? If you were to buy the home's going to be more expensive because of appreciation. So you don't need a 240 mortgage, you need a 280 mortgage. And the rate's not 2.875, it's 6.625. So what did your monthly payment go? To buy the same home in 2021, your payment was $1,000. In 2024, it's $1,800. That's an 80% increase, or $800 a month increase. Now, how much of an increase do you need in monthly income during that time? Do you need 80%? No. To offset $800 a month, you need a 20% increase. Incomes have already gone up by 15%. So you can make an argument that as rates come down in 2024 and as income goes up during 2024, that you will pretty much bridge the gap on affordability.